Brett Hickey is up next from Star Mountain Capital. He's going to be presenting a panel on current opportunities in private lending and private lending secondaries in the U.S. market. Very popular topic today. Brett, we did cut into your time. I'm the next speaker, so I just wanted to, I'll give you my time. So you can go over to let's say 105, if that's okay with you.
Great, Michael. Thanks a lot. Hope everybody's doing well. Are we good then to kick off now? You can hear me okay?
Yes, I can hear you good, and thank you for that. Everybody's doing good on my end.
Perfect, thanks. Well, good, I guess good morning for some and afternoon for others. Pat, Jeff, and Jeremy should all be on now as well. Looking forward to discussing different trends in private credit. I think to set the stage a little bit, I'm sure as everybody knows, over the last decade in particular, alternative credit has boomed as an asset class. A lot of drivers behind this, including the change in bank regulations and commercial banks retracting from a lot of lending markets, which came in largely post the last recession with the Volcker rule and different restrictions that way. And as a result of that, a lot of private credit managers have emerged, different types of private credit strategies have emerged, and it's really become a very large asset class. So that creates both challenges and opportunities for direct lending as well as for secondaries. Now that it is a big and emerged asset class, there are more LPs, there are more GPs, there are more assets, and that means there are more opportunities for people to look at secondary type of opportunities, which hasn't really existed prior to this downturn, certainly not at this type of scale and this type of volume, given the maturity of the asset class now. Today, we've got a great panel that I think you'll all find helpful, bringing different perspectives. Star Mountain Capital being exclusively focused on the lower middle market in the US, with businesses that generally have between 3 million and 20 million of EBITDA. We have a number of different strategies that invest into this marketplace, including direct lending, largely focused on what people call non-sponsored businesses. That is companies owned by founders and or family type of businesses versus larger private equity firms. We then have Pat Clancy representing KKR. KKR is particularly now with their recent acquisition of Global Atlantic that I think added another 70 or so billion of assets. I'll let Pat talk more, but Pat really brings a great perspective of global private credit and particularly the middle and large markets, as well as I said, they're now one of the largest private credit investors, I believe, probably in the world, but certainly in North America. And then we also have Jeff Mitchell from a bank's perspective in what are commercial banks currently doing, where are they active and not. I think Jeff will really bring a great perspective because they are active, they're doing business, they're in business, and so he can really talk about, you know, how are banks acting today and bring their lens to the table. And then at a slightly smaller end of the market relative to Star Mountain, we have Jeremy Hill with JB Capital, and Jeremy focuses predominantly on, I believe, sub 10 million of EBITDA businesses, and perhaps even a little bit smaller than that, so he can bring a great perspective there. So I think in totality, we've got a really diverse group of people covering the spectrum of private credit. So with that, why don't we do quick introductions beyond what I did. We'll go in order of what I have written here, Pat, and then Jeff, and then Jeremy, and then we'll start to dive into some topics. And we really want to make this interactive. So for all the folks on the line with us, please do come up with the questions you have, type them into the Q&A, and we will get to them. This is about, you know, engaging together, sharing experiences, information, so we can all collaborate versus us kind of speaking to all of you. So we really do encourage that. And with that, I'll pass the baton over to Pat.
Hey guys, can you hear me okay?
Yes, thanks, Pat.
Great. Hey, so Pat Clancy here, who I'm a member of the private credit group within KKR. I joined back in 2015 when the business was significantly smaller. Since then, we've grown our private credit AUM to about 30 billion. That spans a number of different kind of pools of capital. We've got opportunistic credit capital that will go kind of top of capital structure all the way down to structured equity. That's the group that I largely invest out of. We've also got I think it fluctuates, but the first or second largest publicly traded BDC complex, which is FSK, which is obviously a growing part of the private credit market. And then we've got our standard direct lending partners funds, which target first lien, middle market, upper middle market lending, and that's obviously been a pretty big growth area for us as well. So glad to be on the panel and look forward to speaking with you all.
Great, thanks, Pat. Jeff. Jeff, you may be on mute right now. Why don't we switch over to Jeremy next, then we'll pinch hit, and then hopefully, I know Jeff is on, so Jeff, again, you may just be on mute, but why don't we switch over to Jeremy?
Wonderful. Thanks, Brett. I appreciate it. And so first, Michael, Jeff, Brett, thanks for having us on. Excited about sharing some time with you and hanging out with you. And Pat and Jeff is a good motley crew to spend a few minutes with. So appreciate you including us. So us for JB Capital, I guess we bring the alternative perspective to a KKR and Apollo, or the world outside of the KKR and Apollo from the lower middle market. So I've had JB Capital in the Seattle area since 2003. And so kind of the original formation of the business was investment banking, capital markets advisory, about $1 billion in transactions over the last 17 or 18 years. And then kind of fast forward to most recently, we made the election a little bit better than 12 months ago. It is to incept our principal credit strategy, and have been kind of off to the races now, investing from a principal position and kind of moving away from the traditional investment banking and advisory work. And so our focus has really been on lower middle market. So the guys that and the companies that are past the friends and family, mom and dad, rich uncle round of raising money, but are not yet to a point to where they can warrant attention from anybody with any real dough. And so for those folks, it is we provide a very good alternative approach. It is to private credit.
Great, thanks, Jeremy. And Jeff, do we have your mic back working?
I believe I do. Can you hear me?
All right, back in the game. Go ahead, Jeff. Thanks.
Sorry about that. We finance a lot of technology companies, but I pretend to be technology oriented myself. Good afternoon, everybody. As Brett mentioned, I'm part of the middle market lending group here at Woodforest National Bank. We're a privately held bank headquartered just outside of Houston in the Woodlands, Texas. As of April, the bank enjoyed total assets of about $8.4 billion. Our commercial efforts are covered through our LA office. We've got an office in Houston, Dallas, Tampa, Fort Lauderdale, and Charlotte. And we cover all 48 states from those offices. The commercial side represents about half of the bank's business. We focus primarily on senior debt to middle market companies with a minimum of $3 million of EBITDA. Typical commitments range from 15 to 35. We can certainly go higher than that. We have a full service syndication desk and are leading quite a few transactions. We do both sponsored and non-sponsored transactions. My personal expertise is in asset-based lending and structured finance. And we also do quite a bit of acquisition financing and cash flow lending. As a side note, we do have a strong retail presence with about 750 branches in 17 states. About 735 of those are in Walmart stores around the country. We've got a great relationship with Walmart. and Woodforest is Walmart's largest retail partner. Looking forward to participating in the panel today. Thank you.
Great, thanks, Jeff. Why don't we dive into opportunities, right? We're all here today to look for opportunities and try to forecast the future as best we can to also avoid challenges. So we'll start off with the first question as far as where we are each seeing opportunities today. So from Star Mountain's lens, we'll touch on two different sides. On our first vertical of our value-added direct lending, we've closed over 75 direct loans under the Star Mountain brand. We have a 40-person team that's closed about 500 transactions in total across our careers. And what we today find the most interesting is really driven from two different things. There's a lot of stuff going on, from politics to COVID and everything else, that one of the trends that has a little bit been lost is the retiring and aging demographic. And within that, that creates a lot of demand for transition type of capital finance. And so what we today are finding the most interesting on our direct lending is helping business owners finance strategic acquisitions. Recently, we helped buy a competitor for one of our portfolio companies out of bankruptcy at a valuation that we believe should be very attractive and accretive to our portfolio company. And there are also other just high quality businesses that say, I'm at a point in time where I'd like to take a step back and be a chairman versus CEO, spend more time with the grandkids and things of that nature. So a lot of acquisition transaction financing, especially with the owner operated businesses, that really a lot of the driver of them doing a transaction is their own personal lives. And so as our population has aged a lot in the US, that opportunity set is larger than it's ever been. On the secondary side, we talked earlier where it has been really a burgeoning asset class, and you combine the very large size of the market with the hundreds of different private credit managers, and then you overlay a challenged market environment and that same retiring population. Most firms don't build into a KKR. What happens to most smaller asset management firms, eventually they break apart and just sort of stop, teams leave and so forth. They don't turn into a KKR, a Blackstone, or so forth. And so that creates a lot of opportunities to take over portfolios, take over assets. Sometimes they're called GP restructurings. We're starting to see quite a bit of that, and I assume that we will see more of that as Q2 numbers come to life over the next few weeks here, and as this recession continues to kind of play itself out. So that's where, those are really the demand drivers for where we're seeing opportunities that we think are the most attractive in today's economic environment, both of which have a lot of complexity and labor associated with them, which is where our specialty really lies. Taking a different lens now, Pat, across your verticals, what are you guys finding most compelling today? What kind of opportunities, whether it could be an industry trend, it could be a situational dynamic. Where are you guys hunting today and finding things the most fruitful?
Yeah, thanks, Brett. I think there, from a broad perspective, we're pretty focused on finding opportunities that have some element of current cash flow, current cash pay. So as a firm, we're actually more targeted and more axed in areas such as infrastructure, private credit, more specifically within private credit, asset-based finance, which is a large part of our private opportunistic credit strategy. So areas such as single family rental, auto lease and loan, and so and on the infrastructure side, we while we've become more our senses have been heightened around the potential for inflation. We still think there are a lot of deflationary pressures, and so we think reinvestment risk is pretty high. But with that said, a focus on cash flow compounding businesses or infrastructure deals that have some sort of indexing that will help create inflation and drive returns over the course and life of the investment. We still remain really, really positive on housing. We've got a lot of housing exposure, and we've actually seen that hold up pretty well. I think historically, over the last 10 years, our belief is that there's been a pretty significant underbuilding of residential housing. So across single family rental as well as multifamily is an area that we have been and are certainly continuing to lean in as one of our main themes.
That's helpful, Pat. That's probably something that many might view as contrarian, but taking a data-driven approach, which I know you guys obviously do as a firm, that's helpful to hear. Thanks for sharing. Jeff, where are you finding opportunities today that you're generally the most enthusiastic about?
Yeah, it's an interesting environment, as all of us can attest to. A lot of banks say they're lending. Woodforce actually is. I would think that we're being much more thoughtful and methodical, though, about the types of companies that we provide financing to. And, there's still a lot of uncertainty, but we see a lot of opportunities in the market. Really focusing on companies with increasing demand for their products and services. We're seeing a lot of requests from janitorial and cleaning services, some of which are tech enabled. Obviously that's an industry vertical where they are just, super busy right now with opportunities to service existing customers as well as take on new customers. Some of the more sophisticated companies are also using that opportunity to identify potential targets around the country in geographic areas that they're currently not servicing. So we're seeing an opportunity to provide some acquisition financing for those opportunities. We're also seeing a lot in just the technology sector alone, any kind of technology that focuses on distance learning, telecommuting, teleconferencing, anything that would improve the efficiency of how things were done pre-COVID. Those companies are getting a lot of attention. We're also seeing quite a bit in the clinical research space, in particular, data mining capabilities and data sorting and data interpretation. Those are all types of companies that we're seeing opportunities to lend to.
That's helpful. Thanks, Jeff. Sounds like some places that have some good secular macroeconomic trends associated with them. Jeremy, where are you next? What kind of things are you finding compelling in this current market environment?
Sure. I think, you hate to, find a silver lining amongst the craziness that we're in, right? But for us, there's not too much different. It is 6 months ago than we're seeing today, although we are seeing a significant increase in demand. I think for our type of borrowers, there's less options for them, or at least the perception of less options for them. And so normally, if they're going to a ABC bank, right, whoever their bank is in their community or their region it is, we're finding it is that a lot of the banks have been overloaded with the demands it is as a result of PPP, and then following straight behind this new Main Street program, plus dealing with their existing clients it is that are trying to draw down anything it is that's unused off of their credit facilities, is that the normal bankers are kind of overloaded with the demands on their current schedule and the demands of their existing clients, and are candidly having difficulty it is looking at a new credit it is that may be fundamentally a good business but is just not getting the attention. And so That coupled with the fact it is that, as we're seeing every week on the wire, there is a new larger fund and larger fund and larger fund going on, is that the folks that don't need to borrow 50 million, they need to borrow 5. Those folks are kind of having to figure out things to their own good devices, which candidly is increasing our business. And so the demands there for us is that we're actually seeing an uptick in the quality of credits it is that are coming across our desk that not necessarily, 6 months ago we wouldn't have seen, but, we're seeing companies it is that, I would have been super excited about. Now I feel privileged it is to look at today it is. And so I've been very pleased with that. So I would say we're actually seeing higher quality credits in my world. And then secondarily, the opportunities it is that we're seeing is in kind of the smaller secondary market. And so not necessarily the larger publicly traded BDCs and publicly traded REITs that are maybe having some liquidity issues and forced to sell, but there's a tremendous amount of smaller regional lenders that are either direct lenders in real estate or private credit or one thing or another that have been operating in candidly a really good market, but maybe they've been operating off of leverage lines or flow agreements, or they're selling their paper to a hedge fund or one thing or another, that now that a lot of those guys are having liquidity crisis, it's forcing that to go downstream. These guys are in a situation to where they can't necessarily originate a new loan August 1st without either a maturity in their portfolio or selling assets to force liquidity. And I think that even at a smaller scale, we're starting to see what it is that, the recent news of Citi and JP and these guys allocating for NPLs. We're starting to see that in a smaller scale with some of these, $300, $400, $500 million lenders, $1 billion lenders that are forced to sell some of their book. And we're looking at that as kind of opportunities for us, even in the smaller scale of the world where it is that we exist. So I guess 2 things. Number one, we're getting better opportunities for better credits traditionally that are just having trouble finding a home because people are busy. And then secondarily is the markets here for some of these smaller, regional or niche, private lenders that are, having liquidity issues.
That's helpful. Thanks, Jeremy. A related question is, we've seen the data that capital inflows continue to come into private credit secondaries, as a lot of investors are uncertain what the economy holds ahead, and I presume looking for more defensive strategies, absolute return type of strategies, and yield type of strategies, as Pat also mentioned. Maybe starting with you again, Pat, from a investor base, just broadly speaking, what are you guys currently viewing as far as when investors are interested in private credit? What is it that you feel they're looking for today in that?
Yeah, I think, LPs tend to be focused on, particularly in the current environment, an exhibited track record of downside protection and the ability to preserve capital even in instances where you maybe get the underlying thesis wrong. And so, that's certainly something that we've been very focused on, and also we've done a lot of detailed work kind of outlining our track record with respect to where maybe we're going through a restructuring, what's the actual kind of outcome that's driven from that. In addition to that, I think one thing that we've been a big we've focused on a lot in our discussions and marketing, and this is true across all KKR products, is in our view, again you're hearing me kind of repeat this a little bit, in a low rate environment, which is what we think we'll be in at least for the near to medium term. The illiquidity premium becomes incrementally more important. The lower base rates are, and so we think that's something that is going to continue to drive capital flows out of public markets into private markets, particularly as you have pension funds and insurance companies that have, fixed rate liabilities, and decreasing, available returns in, liquid assets, particularly government bonds.
Very helpful. Yeah, and as the population continues to age, I guess similarly, people that are looking for like a pension and an insurance company that want capital protection and want that current income and trying to make a return above what they can get in public market securities. I presume that aging demographic is also going to be more interested in having their money work for them, as people like to say, and be able to live off of that income stream. We'll skip over you, Jeff, on that, unless you have anything else to add. Jeremy, what are you seeing? We've noted, looking at all the data, that capital inflows continue to come into private credit and private credit secondaries. What else do you believe are some of the drivers of that continued interest?
Well, I mean, I think you have two things, and I'll certainly echo what you and Pat said, is that regardless of your politics, policy is going to dictate the fact that we are going to be in this zero or near zero interest rate environment for some time. And so with an aging population, and whether it's Bob and Mary Smith trying to fund, retirement obligations and put their kids through school and gas in the car and pay tuition and whatever else, or whether it's, a large insurance company or pension fund that's trying to, fund long-term liabilities. In the environment it is that we're in, you're going to be forced to go out on the risk curve in order to search for yield to fulfill those obligations. And so obviously it's been evidenced by what's going on now, and what it is that we've seen most recently is that the further you go out on the risk curve, the further you go out on the branch, the shakier that it gets. And so how do you, in the search for yield, begin to look at opportunities to mitigate risk? Because those retirement obligations or pension liabilities or otherwise are not going to go away, right? Like I've still got to put gas in my car. And so the points of conflict and consternation from some managers across the country is, how do you look at a potential mismatch between what is perceived as maybe some buying opportunities that have come in the equity markets over the last several months, with mid to long-term capital appreciation not aligning to an investor's need for income, whether it's mailbox money or otherwise, right? And so I think that that's driving a lot of things towards the need for alternative solutions, and private credit and private debt being one of those. I think that that's an enormous demand. I think the second driving demand to this is that we've seen over the last kind of 5 or 7 years, with the sheer amount of capital it is that's been going into private equity, private equity has kind of drug the private credit markets along with it, right? And so numbers, don't quote me, but numbers, I think, 6-7 years ago in the private credit markets were roughly, $220 to $240 billion in assets in the private credit markets. That number, I think, is now 900 approaching. And so you are seeing this kind of tandem approach to the growth in private equity, and private credit coming alongside that as a, kind of a yield enhancer for private equity, as a tool it is to help them. And so I think those are kind of the two big driving forces that we've seen this massive influx into the private credit markets over the last several years.
That's great. Thanks, Jeremy. Yeah, and in an uncertain world in particular, the defensiveness seems to be of interest to a lot of folks. Jeff, anything, maybe a related but slightly different question for you, which is, when borrowers are looking for capital, from your bank and other banks, what should they expect in today's environment? I know you guys are, of course, we've done a lot of business with you guys and are great folks and are responsive and so forth, but just maybe a little bit more generically speaking, to help provide some context about banks in general for borrowers, people looking for capital. What should they expect different today, whether it's around covenants, whether it's around how much time is taking, amount of leverage, anything else that you think would be helpful, boots on the ground context for folks as far as how banks are operating right now?
I think because we're still in the throes of all of the uncertainty, I know we are keenly focused on liquidity, as most banks are. Um, we're we're asking our borrowers that are coming to us for new loans to really have thoughtful projections that they can provide us, which are very difficult to do in this environment because unless you have a crystal ball, what you come up with is going to be very different from what actually evolves. Nobody knows whether we're going to be in a V-shaped recovery, a W-shape, or a Nike swoosh. And on any given week, it seems like things change. So what we're really trying to do is, again, focus on companies that, are in sectors where they had demand before this, because of the events that they're currently experiencing, they're likely to increase that demand. And when they prepare forecasts, we're really looking for the next 12 to 24 months as best that they can foresee, putting together both baseline, projections, upside and downside, just so that we have kind of a good, better, best type of scenario. But again, dovetailing back to the liquidity and the sponsor support that they may have in the capital structure. So that's really what we're focusing. We're also trying to understand, the various sources of support. So hypothetically, if they've got a capital structure, in place that includes senior debt, some sub debt, and some equity, just to ensure that that liquidity is there should things turn worse in this environment. We're concentrating on both the sponsors and the existing owners to provide some sort of backstop support in the form of, either capital calls or some sort of standby, letter of credit or line of credit, just so that we can make sure that the company maintains liquidity through all the uncertainty.
That's helpful. So in order of priority, Jeff, it's liquidity, liquidity, and then liquidity, if I got that right?
Absolutely.
Very helpful. As we look at protecting capital as obviously a core focus for us all in the lending business, we had a question from Ted. Thank you for the question, Ted. And we'll start with Pat. What are some key things we just heard from Jeff, how his such a keen focus around liquidity and obviously a business's ability to continue to pay. Pat, you gave a bit of insight already into thinking about macro trends and how you're forecasting, making sure you've got a good macro thesis to kind of build into. Any other things that you really think are critical and top of mind today in particular, as you focus on continuing to have that current yield persist from your loans as well as capital protection?
I think it's pretty idiosyncratic. I think liquidity and derivative of that being a sustainable capital structure, not necessarily for today, but certainly not just for 2019, right? Because I think it's gonna, for a lot of businesses, it's gonna be some time before we're there. So I think for existing investments, we're looking to make sure that whether it's with our capital or others, that we're putting businesses on kind of steady footing to
You might be cutting out there, Pat.
probably navigate. Any better?
Yep. Yeah, we're good again. Thanks.
Yeah. So and so I think it's it's focusing on that that kind of sustainable capital structure, as well as just ensuring that we have really the right and strong management teams, and we've continued to kind of work with sponsors, or in instances where we're equity holders, still looking to upgrade the management teams, as well as ensure that if a business is potentially heading towards some sort of restructuring, that whoever's in there has experience in those exercises.
That's great. Yeah, it's a good point on that, Pat, and tying together an earlier point that you made as well, which is around the making sure that investors are looking for managers that have workout capabilities, that have experience working through challenges, where we're all good when things are going well and up and to the right, but it's when you have challenges and there's a lot more stress and complexity around that, having the experience to work through that. I know for us, having the control buyout expertise as a core part of our orientation as what we call value-added lending is certainly important, because sometimes you do have to work through more challenged situations, and making sure that, just like Jeff is looking for people that have the capabilities and expertise. And that's an interesting dynamic with COVID, as we all want to know our management teams as well as possible. That's something that's certainly been evolving, I'm sure, for us all. One of the things I know that we've done is opened up additional local offices across the US, most recently in Dallas and in Denver, where our goal is to have people within driving distance of the companies that we're investing with and doing due diligence on, and the management teams. We as a firm are currently not getting in airplanes, but we're happy to get in our own cars and have socially distanced meetings and really get to know people at a deeper level as part of our underwriting process. Jeremy, switching over to you now from a capital protection standpoint, what are some of the other things that you're even more heightened on? Obviously going through multiple stress test scenarios on credit cases and credit cases, and maybe just adding in Jeff's point of what's the recovery going to look like. I read something in the Wall Street Journal today that was really what we think of it as a swoosh, but written with a very shaky hand, right? Not clean and up, but really having some S's within that recovery that's I think going to have some still challenges. Love to hear what you're thinking on that front, and addresses one of the good chat questions we had as well. Thanks.
Yeah, so thanks, and thanks for the question from Ted Parker. The reality is that it's tough for everybody, regardless of your experience. The market seems to be pretty dynamic and ever changing, and what it is that we thought was going to be a normal 30 days ago is different than what it is now, and maybe different 30 days from now, right? And so for us, we're doing a couple of things. And I was listening to a Goldman podcast a couple of months ago where Solomon was on it. He just said, everybody it is that's in the credit business just became a bridge lender. Whether you think you are or you think you're not, you are, right? And so if you're issuing 3-year paper, it's now 4-year paper. If you're issuing 5-year paper, it's now 6-year paper, because we're all going to be in this situation over the next 12 months to where, candidly, we're just kind of figuring shit out. And so I think that it's critical for us as lenders working with borrowers, it is that number one, we spend the time up front as you are endeavoring it is to structure the deal, is that oftentimes we've all been in this long enough to know it is that as we're looking at a deal, or as we're looking at refinancing somebody else's deal, is that the deal was set up to fail to start with, right? And so I think for us, we are making sure it is that we are doing everything it is that we can to protect our borrowers from themselves, right? To set things up to where it is that we remove opportunities it is for them to do something that would be harmful for their business, right? While keeping in mind the fact that us as lenders have obligations it is to meet our LP commitments. And so what can we do to make sure it is that, candidly, you're serving both masters, right? And so do you need to work on a structure it is that for them maybe the next 6 months or 12 months you're either pre-funding their interest, right, so they can focus on the business, and we can kind of worry about how COVID's going to take shape over a certain period of time, or you're moving in and you're doing half current and a half pick or something. It's not that you're throwing the rule book out the window, but I do not think that this is the period of time it is to hold a super, super, super hard line and allow your borrowers to go into default. Because again, this is all a period of time for this kind of next 12 months to where we're figuring things out. So for us, we are spending even more time up front, making sure it is that we're creating a structure it is that we feel is going to allow our borrowers to succeed, number one, right? And then we're not that we're not already, but we're a little bit more flexible and creative on terms it is that's going to allow them to move through this as we all get our feet back under ourselves for what normal is going to look like.
Yeah, that brings up a good point, Jeremy, and the old adage of the best way to manage a risk is to avoid the risk up front. So doing a little more homework day one and really going deep into sectors, management teams, capabilities, and then as Pat mentioned, also looking to build up and amplify the team as you go. That's certainly one of the things that we do, which both fits the ESG lens as you're building up governance, and then also the S and social, looking to bring additional women and minority folks onto the board. So it's something that's of value to the business, while also being able to create additional value from a societal perspective that way as well. Had a question here from Robert. Thank you, Robert. And this is like, I guess for we can do. Why don't we have Jeff answer this question, just because you have additional insights given your joint venture, your relationship with Walmart as a gorilla in the retail space. How are you guys currently looking at retail investing and lending in general, Jeff? Are there parts of the retail chain that you are willing to invest in and or are investing in?
So we've had for 35 years before Wood Forest was a commercial bank. They were a retail bank that was focused on pure retail banking, financing and providing banking services to individuals across the country. We've got that strategic alliance with Walmart. We're not owned by them, but we're fortunate enough to partner with them in the sense that we've got branches in a lot of the Walmart stores. I'm not aware of any plans for additional expansion in the retail area.
Sorry, Jeff, I could have framed the question better. I think it's more coming from an industry sector. You mentioned technology and some sectors you like investing in, but as far as retail sector, different retail businesses in general, when people come to you looking to borrow money for their retail business, are there any sectors of the economy within retail that you are open to, and are there sectors that you just really won't touch, if that makes sense?
Yeah, it does. So we really don't finance a lot of retail types of companies. We do have some exposure to hospitality, but it's minimal. And again, our focus right now is really looking at companies that are currently needed and appear to have continuing demand for their services. So we're not opposed to considering opportunities to lend in the retail space, but again, we're being very selective in that regard.
Very helpful. I know as a bank, you're not really looking to generally take extra risk and get compensated for that risk and try to price that risk as much. Maybe flipping that question over to Pat, where you have the flexibility to try to analyze risk more and price risk and try to get paid. Are there sectors within the retail economy where you guys are currently seeing opportunities and or places that you really just won't touch?
Yeah, I think I think my personal view, and I think a view that we've taken at the firm, and as you've seen, I mean, there's been a lot of press about all of the deal activity that KKR has had. I think our view is there's a price for everything. but we're pretty focused on, and this isn't particular to retail necessarily, but we're focused on, I think, whether it's investing in credit or equity, or somewhere in between, in kind of a convertible pref that we've done for a number of companies. But I think a mistake that we made in the last downturn that we don't want to repeat is, I think a lot of people will look to buy things just because they look, quote unquote, very cheap. But I think something that is pretty typically happens during a crisis is that it accelerates a lot of trends that maybe were already happening. And so while something may look cheap, you could have a real instance there where the business model is kind of no longer suited for kind of the new world that we might be in. And so we're more focused on investing in good or great companies at reasonable prices than challenged companies at what are maybe perceived as bargain prices. So I think we made a number of investments back in the last crisis that on the surface and looking at past multiples, et cetera, look to be really, really cheap entry prices. But those, that was there, there's a reason for that. And then those business models, like they were kind of on their way out, and the crisis had the effect of merely accelerating that.
Yeah, it's a good point. Whether it is something truly a slow melting ice cube and going to stick around for a long time, or as the world, as you mentioned, escalates, changes in economies. That's a really good, I think, point that you made for everybody, is that changes happen a lot faster at companies and therefore in economies, in distressed markets. And so, businesses that might have been a slow melting ice cube may just go away. And that's a tough bet to make, and not wanting to catch the proverbial falling knife. Whereas in other businesses, you might have companies that have balance sheets that were just not well structured, and they went into this economy with too much leverage, and too much leverage, as Moody's and other people have well pointed out over decades of research. Just that tends to be your single largest determinant of defaults at the end of the day. And as the economy is changing rapidly now, even perhaps more rapidly than ever, because of the compounding effect of technology's ability to innovate a lot faster than it ever has been, overlaid with the downturn, maybe switch over to just Jeff. We'll do some real quick questions now for each person. We'll start with Jeff, and then we'll go to Jeremy, and then back to Pat. Is what are one or two industries that you think might be changing faster than other people think? So as you kind of shine off your crystal ball a little bit, what are some of the things that you see in it? Why don't we go in that order then, starting with Jeremy this time, please.
Starting with Jeremy. I was really hoping you were going to start with Jeff.
I was too.
All right, so industries that are changing are going to be fast forwarded. So, the first thing that comes to mind obviously is healthcare, right? And so, whether it's Gilead and everybody else working on a vaccine or some response to COVID, or whether it's reframing and reshaping what it is that our perception of healthcare looked like, right? So like I've long been a fan of the telehealth business. And so obviously the telehealth business has been fast forwarded dramatically into the limelight as a result of what's going on with COVID. I think that there's going to be extensions to that. Like I saw something goofy the other day on the wire that a new company had just raised money. It is for virtual dog training, because people are not excited about taking their dog to a trainer. We're going to do it online, which God bless them. If you can figure out a way to do it, good for you, right? So I think that there's going to be fast forward changes in healthcare. I think it is that, my wonder is, my family, when we have a normal experience of just going to a grocery store, a Costco, or anything like that, is that, you know, the new normal is, you know, single file line, 6-8 feet apart, you know, plexiglass in front of you and that kind of thing. So what is going to change in the normal consumer spending, consumer shopping market? It is like, are we going to move to, you know, a near totality of food delivery, grocery delivery, and everything like that, right? And if so, what happens to the commercial real estate space that every Walmart, Target, Costco, you fill in the blank, is going to happen? So I would say probably consumer retail, that's going to be completely reframed. And I would say healthcare may not necessarily be reframed, but it's going to be fast forwarded in the evolution of how that business operates.
That's great. Thanks. And why don't we go to, I know Pat's got to jump at one here. Pat, and any kind of quick tips? I think your view on the housing market was insightful. Any other kind of macro type of tips that you think of?
Yeah, I think transportation. I mean, this is, you know, not nothing earth shattering, but I think transportation and specifically, you know, an area that we spend a lot of time is aviation. And you know, a company that we own, Global Jet Capital, which is you know, the largest non-bank lessor of business jet aircraft. That's a you know, a company that in past recessions would have seen you know, massive challenges in a time like this. But given the nature of the crisis, that business has actually performed phenomenally. As you know, people who can afford you know, to you know, fly in a way that is you know, opening yourself up to less exposure to a potential virus are more inclined to do so now. And on the flip side, commercial aviation is going to go through a really challenging few years here, and that's across the entire value chain. So that's airlines, that's lessors, that's OEMs, that's our MROs. And so, you know, our belief is that commercial airlines, you know, particularly given what could potentially happen to business travel and kind of the lack of business travel, really, where a lot of the profitability is driven, you know, there may be yet another, which seems to happen every 10 years, you know, kind of wholesale business model change out of airlines.
That's helpful, Pat. Yeah, and it brings up another really good systematic point that you talk about, is really understanding who are your buyers, what is your end market, and in that case, if you have an end market of people that are high in the affluency area, that part of the population has generally stayed reasonably wealthy, and if they're willing to, you know, rent planes for family vacations and for business and things of that nature in a more socially distanced type of manner, that's good for everybody to think about what is the end market and which end market typically gets hurt more in a recession, and the ultra wealthy end market consumer products and services tend to be more resilient that way. That's a good point. Jeff, bring us home. What are some other good, what are some good things you see through your crystal ball?
You know, I think, you know, we've given some thought to really the differences, you know, in consumer behavior and how companies have operated during the Great Recession versus this recession. You know, the biggest difference, you know, the financial crisis, you know, is really what led to the Great Recession with liberal lending to subprime borrowers. You know, when that ultimately burst, it took about 18 months for that recession to fully unfold between 07 and 09. At its worst, GDP was down, I want to say only down 8.4% in the fourth quarter of 2008. When compared to this, you know, environment, this is a true health crisis. And we've got the potential of having a greater impact in one quarter on GDP than we did during that entire recession. So I think from a company standpoint, I think companies are, you know, whether you're in the obvious sectors that are being affected, commercial airlines, hospitality, restaurant, clearly those folks are going to have to dramatically reevaluate their business models. But I think every company really is going to have to make tweaks to analyze better their supply chain, analyze, their availability of capital to maintain liquidity for these stops and starts that were going on. And, and management's going to have to look in the mirror to be honest with themselves, to play to their strengths and identify what sort of bench strength they need to do this. So it's an interesting challenge for everybody, and it's going to be interesting to see how this evolves. I think the vaccine is really the game changer. If we're looking to that new normal, I think it really hinges on a vaccine, and how long it'll take to get there, who knows? But until then, it's going to be, a bumpy road.
Thanks, Jeff. Very helpful. And maybe a couple last things to tie up a number of different thoughts and what's going on in the macro economy with our Chief Risk Officer at Star Mountain Capital, Dr. Lev Borodovsky, who ran global risk for the alternatives business at Credit Suisse that my partner Brian Finn was the head of, and then was the founding Chief Risk Officer of GSO Blackstone. We do a piece that happy to follow up if any people wants to shoot me an email, where we share content and really synthesizing and bringing global trends together, because even though as Star Mountain we only invest in the US and in Canada, you have to really have your finger on the pulse of what's going on globally, what's going on in technology, what's going on in industries, how are industries going to be reshaped. As you've heard from Jeremy, Jeff, and Pat, there are a lot of changes that are going on. And one of the things that I would say we can all probably safely guarantee you all is that we don't know what all those changes will look like, right? That's probably the only thing we really can guarantee. And when you think about the world in this reality, we got hit by a pandemic. Hopefully people had, strong liquidity in their businesses, didn't have too much leverage from a balance sheet structured perspective. And those are obviously really critical components of whether it's an idiosyncratic risk of a company or a more macro driven risk that's hitting the whole economy that derivatively hits, most businesses. I think it's worth mentioning that the vaccine, as Jeff points out, it's very uncertain how quickly we will have a safe vaccine. There are pros and cons. Thankfully, there are a lot of people putting tremendous efforts towards it, and we certainly hope that it'll come along quickly, but it could very well take some time, measured at least in quarters versus months, certainly at minimum. Whether it's years or not, I sure hope not. Another thing is we won't get into politics, but there is the potential risk of tax increases. There's some probability certainly that the Democrats will, win the next election, and that probably comes with it a reasonable probability of tax increases. And as a lot of us, I think, worried about a recession coming back in 2016, I know in Star Mountain we certainly did, and we took a pretty defensive approach heading into the last few years, and perhaps the economy was lifted by the tax reductions that came in from a policy perspective that pushed this economic expansion that we just came out of a little bit longer. Well, that could perhaps get pulled back. There are other black swans flying around out there, from trade wars to actual wars and so forth. And therefore, what I'm sure we would all suggest is prudent is being defensive, being diversified, and really deeply understanding what you're doing and or backing people that are deep specialists in what they do. So with that, thank you everybody for your time. We hope this was helpful and constructive. If anything else we can help with, please let us know, and hope you enjoy the rest of the panels and the rest of the conference.
Brett, Pat, Jeff, Jeremy, thank you all for leading such an interesting panel. And Brett, there's a couple of people asking for copies of the presentation, the research you just mentioned, and asking also for contact information for the panelists. So I'll be happy to provide that, but perhaps Jeremy or Jeff, you guys as well, could follow up and provide answers to these questions. Guys, thank you very much for doing this today. I'm going to switch screens here, so just give me 1 second as I pull up my presentation. I am going to be the next speaker today, and I'm going to talk about the Flya Digital platform, also walk you through a little bit of the functionality on the actual website, and show you how you can use different tools to really continue the business development during this pandemic, which is definitely a new experience for all of us